So I would now like to formally introduce our alumnus expert, Tom Kotozich. So Tom Kotozich, MBA, is a youth and college financial manager at Virginia Credit Union. Tom has a bachelor's degree from West Virginia University in multidisciplinary studies with a concentration in business administration, communications, and sociology. An executive MBA degree right here from Virginia Commonwealth University, class of 2018, and over 15 years of experience in financial services. Tom manages all of Virginia Credit Union's financial efforts for K-12 and college students. This includes the development of the Virginia Credit Union Financial Success Center at VCU, which we are partnering with for this event, a $5 million endowment to the VCU School of Business dedicated to funding financial wellness resources for the VCU community and academic research on financial health. So without further ado, I am going to turn it over to Tom.
Awesome. Thank you so much, Letitia. And I appreciate all you guys who are tuning in today. As she mentioned, there was another speaker lined up who's one of my favorite people. There was a little miscommunication, so I was glad that I was able to kind of step in here and help out. Today, we're going to be talking about one of my favorite topics, which is credit scores, credit reports, kind of how all that stuff kind of works together. I am going to put this kind of in the context of kind of what's going on right now in terms of COVID. I'm also going to reference a little bit for some of you younger alumni, like how to start to build credit or rebuild credit if you are in that position or situation. This can be kind of a complicated thing, but if you really understand how this works and the fundamentals, it will help you make decisions that will pretty much maximize your score. We're also going to talk a little bit about kind of why that matters as well. So I do have the chat box up, so if you shoot questions out, I may catch it as we're going through. I may ignore it till later if I think we're going to review it later on down the line in the presentation. This is a pretty dense topic here, so there's like a lot that we're going to go over. So I hope you guys get some good information out of this. And of course, if you ever need anything or want to contact me directly or need to follow up with anything kind of offline, this is my contact information. Feel free to reach out to me directly, whether you're a member of the Virginia Credit Union or not, which all of you guys as alumni, if you are alumni of VCU, are eligible to be members if you're not already. And if you are already, we appreciate you. Like, it's our members that make this kind of investment in my job and these resources to help people better understand these things, because really it's all about decision making that will have outcomes that will benefit your life short term and in the long run. Like, that's really what this is kind of all about. Like, personal finance and money management is just kind of a tool. It's a part of all of the decisions that we make. It's not everything, but there is like a financial component to all decisions that we do make. And a lot of those things are recorded. And that's kind of what the basis of the credit reporting system is a recorded history of your, financial decisions and some financial decisions and transactions. Okay, so this is kind of what we're going to be going over here today. Facts about the credit scores and how you can use them to achieve your financial goals, and other types of scoring models that are actually out there, and kind of systems that run parallel to the credit reporting system as we all kind of know it or are aware of it. So we're going to start with kind of the basics, and then we're going to break down the different components of what creates your credit score. So first, what is a credit score? It's a risk analysis. It's a risk model. Okay, so any of you who have studied statistics or modeling know that modeling is supposed to be a predictive tool, right? So you use data, use information and data, typically historical data, because that's really the only kind of physical hard data that we can accrue or accumulate. And we use that data to find patterns that will statistically model behaviors in the future. Okay, so that's kind of the concept around what a credit score is. It's one of the oldest and kind of most well-defined versions of risk modeling that is out there, and we'll get into that as we kind of go through here. But basically, it is a risk score for lenders that lenders use, like the credit union. When I say lenders, I mean like banks, credit unions, credit card companies, mortgage companies, private student loan issuers, commercial lenders, things like that. Whenever they're willing to lend any customer or member money, they need to know the likelihood of that being a good lend, right? Of that being a good situation. Now, one thing that we do know about modeling and statistics is everything kind of falls within curves, right? So nothing is like guaranteed, and you look at trends, and models are never perfectly predictive of the future. So if you have a credit score that's really low, that doesn't mean that you're going to default on a loan in the future. That means that you have shown signs that you are likely to default in the future, not that you will, right? Which is kind of how the whole thing is constructed. So hopefully this will make a little bit more sense as we go through. So a credit report tracks your credit activity. There are 3 different credit bureaus that actually collect this information. So it's Equifax, Experian, and TransUnion are the 3 major credit bureaus. They collect and gather the information and make what's called your credit report. So those institutions, it's kind of weird how that's set up because they're called credit bureaus or credit reporting agencies. However, they are not bureaus or agencies of any government body. They're private for-profit companies whose business is to sell data and information about you, the consumer. And their consumer is not you. You're their product, right? So the consumer is the lenders. And I like to bring that up because Equifax is one that was in the news not too long ago about having a credit or a data breach where a lot of people's credit information was exposed. And if you notice, what happened to Equifax is they didn't shut down, they didn't go out of business. Their stock price went down for a little bit. They were penalized a little bit by the Consumer Financial Protection Bureau, but they went on business as usual because creditors still use need their service and need their product. So the creditors or the credit reporting agencies create the report on which your score is based. Okay, so typically you have 3 people that are involved in this situation. You have the lender, who ultimately is the end user of this data or information. You have the credit report company who makes the reports, the credit reporting agencies. And then you also have the credit scoring model, okay, the credit scoring system. So I see a question coming in. This is good. I'm going to actually get to that. That's a good, very specific question. I will get to that question as we go through here. Many creditors look at multiple scores from, and not just a report. Sometimes they will just do like, a lot of this stuff is kind of automated these days to where if you fall within a certain tier, then that's kind of the basis of the loan decision. So many lenders don't actually even look at the reports anymore. It's all getting to be more and more automated. There are circumstances though where you can file disputes and things like that, which again, we'll talk about here in a moment. Okay. So we're going to really kind of focus here on the FICO model. FICO is the most widely used scoring model that's available. They are a company that is independent of the 3 bureaus. There is another scoring model that is starting to become more widely used that we'll talk about a bit about at the end called the VantageScore. But for now, we're going to basically focus on FICO. So FICO is a Fair Isaac corporation. It is actually its own private company, and their business is to sell their algorithm that creates the score based on the information that's in your report. Okay, so it is the most widely used by lenders. Again, VantageScore is starting to get a little bit more prevalent, but as of now, FICO is the one that most lenders still use. That's what we use here at the Virginia Credit Union. And even within FICO, they have different models. So a lot of banks and credit unions still use FICO 8. There's also FICO 9, and they're getting ready to release FICO 10. And each time they release a new version of their scoring model, the range is still the same. It's still 300 to 850. It's just how they tweak and weight different things. Like a new version of the FICO scoring model coming out is going to put less of an emphasis on medical bills and expenses, and it's also going to treat paid collections differently than it had in the past. So I don't know all of the specifics about that because it's still just coming out now. And but you know, these things will make a difference in your overall score in the long run. So as most of you guys know, the higher your credit score, the better. It goes from 300 to 850, as I mentioned. Typically, you don't even have a FICO score until you have at least 6 months worth of credit history available for them to review. So if you just have like a credit card that you just recently opened, or you have a child or a teenager that just opened up a credit card, they probably aren't going to have a score for at least 6 months. Depending on the type of loan you get, some creditors will pull from just one agency, one bureau, and some will pull for all three. I know that for most consumer loans, like a car loan or a personal loan or even a credit card, oftentimes I know we will only look at one. We'll only look at one of the credit bureaus, which we tend to use Equifax ourselves here at Virginia Credit Union. And but if you're applying for something like a mortgage, we want to make sure that we're reviewing all three reports, because though most of those information is the same on all three reports, sometimes there are slight differences in what is reported to each of the three credit bureaus. Okay, so here you'll see the overall chart. This is the pie. Some of you may have seen this before in the past. This is a very common thing when people talk about credit. So as I mentioned, FICO is a company. They use a proprietary scoring system. So the specific information used to generate your score is not available to the public. So when I say things like this will help your score, this will hurt your score, I can only say that in general terms. I can't say this action is affiliated with a 3-point change or a 4-point deduction or whatever, because their scoring mechanism, their algorithm is actually proprietary. But part of the Fair Reporting Act, Credit Reporting Act, and just because like consumer demanded it, the consumers demanded it, they do release this, which is a basic accounting of the components of your credit score. So what we're going to do is we're going to break down each of these 5 components, and I'm going to let you know what they mean and how they can impact your overall score. Okay, so first, obviously, when we're looking at a predictive model, like when we're looking at something that's trying to guess or project or predict the future, the number one thing that we look at is historical data, past patterns, like what you have done in the past. Okay, so payment history is by far the number one thing that is looked at on your score, the number one component of your score. Are your payments on time? If they're late payments, how late were they? How recent were your late payments? Now, one of the things that's not collected is why your payments are late. So that's where this system is a little bit, I guess, cold or callous. Like it's not necessarily, it doesn't care why your bills were late. Now, with COVID, what's going on with COVID, there may be more exceptions made on this going forward, but as of now, if your lender you have not reached an agreement with your lender about being in a statement of forbearance or a state of forbearance or skipped or missed payments that you have agreed to, then don't assume that they're okay if you miss your payments because of what's going on with COVID. There is a strong likelihood that your payments will be reported if they're not made, unless expressly told to you. Like now, federal student loans, this is one thing that is a big thing to be paying attention to now. I guess it was the CARES Act that started this, where all student loans are in forbearance automatically with no interest being charged, whether they're subsidized or unsubsidized. So if you're not making your federal student loan payments, you are not being penalized on your credit report. So that's, you don't need to do anything. That's an automatic statement that's automatically happening. Some mortgages that may have, that are federally backed have different allowances and things like that. But again, you have to be communicating with your lender. Okay, I got another question coming in. That's a good one. I will follow up with that in a second. About buying a home. Okay. Collections accounts and things like that. When it comes to how bad things hurt your score in terms of your FICO score, in terms of your payment history, I should say, is how late you are and how recent you are. So recency and severity are the two big things. If your item is sent to a collections agency and you have legal actions taken against you, that is significantly harmful, and it will remain on your report for at least 7 years from the first issuance of the transaction. Okay, So after a 7-year time horizon, even if like after 2 or 3 years or however many months it is that the original creditor sends it to a collections agency, your time clock only starts at that first initial discretion, not when it's sold to a collections agency. Sometimes collections agencies will try to put that on as a new missed payment or a new derogatory payment history thing on your credit report. You can dispute that on your report. Okay, so it's from the first initial transaction. Okay. Now, the second component that's looked at, that's pretty simple. Like this payment history one is simple, pretty simple to understand. Like pay your bills on time all the time is the #1 way. If you are going to be late, contact your lender. Don't just assume that they will be okay with you missing your payments. Like that's my #1 advice with that. Now, the next component that's sometimes a little bit confusing, but also a big part of your score, as you can see here, it's 30%. Sorry, I skipped forward a little bit. Is your amounts owed. And the better term for this is your credit utilization ratio. Okay, so this is a ratio, which is a fraction. The denominator is your available credit that you have to utilize. So like your balance limits, okay? This is primarily looked at on revolving lines of credit as well. So we'll put that forward. So like credit cards, equity lines of credit, things of that nature. The denominator, the bottom number, is going to be your limits, and the numerator is going to be your current outstanding balance. Okay, so when your score is calculated, it's a snapshot of a given moment in time, and whatever's reported on that day that your report is pulled is what your credit report will look like. That's what your score will reflect. Okay, so if you have a credit card that you use regularly and you pull your credit on one day, and the credit card company has reported your outstanding balance the last time they reported, which usually credit card companies and lenders report all of their stuff on a single day. So like if your balance on your credit card 3 days ago was $3,000 and your limit was $5,000, today you pay it off to zero. When your credit report came out, when your score was calculated, it looked as though you had 3/5 as opposed to 0/5 as your utilization ratio. Okay, so it's kind of a weird thing. That's why scores kind of fluctuate. If anybody has things that track your score overall. So ultimately, you want your utilization ratio to be as low as possible. So if we think about it like this is the example I like to give. If you have 2 credit cards, each of them have a limit of $5,000. Okay, so 2 $5,000 limit credit cards. Your total available credit that you have access to is $10,000. One card has $3,000, the other has a 0 balance. Okay, so right in that moment, you are using 30%, 3/10 of your total credit utilization ratio. Okay, if you decide to close this line of credit down, you can close it down. All of a sudden, your total limit that you have available to, that you have access to, goes from 10,000 to 5,000. So now your ratio is 3/5, which is 66.6%. Now, because of the way that your score is calculated and how much this is weighted in your overall score, your score actually will go down significantly if you carry high balances or if you close lines of credit when you still have outstanding credit over in different areas, like different credit cards and things like that. So it's good to have credit that you don't use. Like if you have a credit card that you don't use and just sits there, sometimes your creditor will actually tell you to use it or they will close it on your behalf. If they close it for you, that will hurt your score. If your credit line is reduced, like what happened in 2008 to quite a few people, that will reduce your score. If you max out a line of credit or if you keep very high balances that you don't pay off quickly, that will hurt your score. Yeah, so ways that you can improve this number is pay down your numerator, so pay down your balances, or increase your denominator, which this is a little bit counterintuitive. So like if you're in a situation where you're constantly running up against the top end of your balance, of your limit, like that's having a negative impact on your score. So it would actually be beneficial for you to go out and either apply for a new line of credit or to ask for a line extension with your current creditor. Again, it sounds counterintuitive. The only thing is you have to make sure that you are disciplined enough to not rack that up as well. Okay, so this one's kind of a funny one. you want to keep your ratio as low as possible. So below 30% is optimal. Lower than that, the better. Like the lower you can get it, the better. There are certain circumstances where you need to use your credit cards. That's the whole point of them being there. But you don't want to ever use your credit cards for long-term debt. That's not a smart way to use exposed unsecured credit. Not a good way to do that. But stuff happens, and that's what those are there for. Okay, so the next component is your credit history or length of credit history. Kind of a better way to describe this is length of open and active credit. So what happens here is typically when you get a loan, like a car loan or an installment loan, when that loan is paid off, your payment history does remain on your credit report, but that actually drops off as a line of credit or a loan on your active line of credits or your active credit report. So typically this is, again, something that's a function of credit cards, because credit cards, as long as you keep them active, can be opened like in perpetuity or forever, right? So basically what this means is like whatever your oldest credit card or multiple credit cards are, you want to keep them open for as long as possible. There's no way that you can go back in time and make your length of credit history longer now, because and that's something that like my parents, my mom always talked about this. She had a credit card from Kaufman's department store, which became Macy's up in Pittsburgh, and they got it in 1977, and they kept it open and kept it open and kept it open and kept it open, and that's still like their length of credit history is from like back in the 70s, before credit bureaus and all this stuff was even like established. And so their scores are really good, and I know for a fact that if they were to close that line of credit, that credit card down, it would probably significantly hurt their score. So with credit history, keep your oldest lines of credit open and in good standing if possible. I see more questions coming in. Let me just get through the components, and then I will stop and address some of those questions. So this is a good, you guys, I see some good ones coming in. Some of them are pretty specific, which I may have to take offline, but we'll see what we can get to. The last two components of your overall score are composed of new credit and types of credit. So this is one thing that's kind of that chicken and the egg scenario. Like, you need to have credit in order to build credit, but whenever you apply for credit, your score actually goes down. Remember, your score is something that is fluid, and it's a snapshot of a moment. So here's kind of how this works. When I apply for any credit, like if I go apply for a credit card or apply for a mortgage or apply for a car loan, when the creditor puts that application in, then my score actually goes down. That's what's considered a hard inquiry on my report. Okay, if I ever actually accept a loan offer, like an unsolicited loan offer, like a credit card offer in the mail, or even like a offer for 20% off at the Macy's checkout or Target checkout or whatever, as soon as I say yes to that, that soft inquiry then turns into a hard hit or hard inquiry, which will be a ding to your score. Now, it's a small point, it's a small percentage, so it's 10% of your score. But the only way that you can build a more robust credit history is by having active and open lines of credit and other types of loans, which that's what we're going to talk about next. The key here is hard inquiries will only stay on your report for a total of 2 years, and they will only actually count against your score for 1. So try your best. If you're in a situation, I know young couples especially, you're in a situation where you need to apply, you may want to apply for financing for stuff like all at once, like especially if you buy a house and then you want to get furniture and do all these other things where financing may be the best financial option for you. If you do all those things kind of in a cluster of time, then it will ding your score a bunch, and that will make your score go down relatively significantly in a short period of time. So if you can, only apply for new credit once every 6 months to a year. But really, you should only be applying for credit when you absolutely need to, except for like, different credit card offers and things like that. Sometimes it's beneficial to kind of play the game that way. The last component is types of credit used. So basically, again, it's a small component, but it does make kind of a big difference in terms of like really pushing your score up from those mid 700s up to like the high 700s, low 800s, which is where my score is right now. I will brag about my score. I take good care of my credit, and my score floats between like 790 and 820. I recently refinanced my mortgage, which now is an awesome time to do it because rates are super low. And because I did that, they pulled my credit, which made my score go down temporarily. So basically what is looked at is if you only have like one or two things on your credit report in general, like this is like that Dave Ramsey kind of mentality is like, why should I care about my credit? I don't ever need to use credit. And if you're able to bootstrap and save and never get a mortgage, there are people that do things financially that are financially successful in doing things like that. But if you go to get a mortgage and you have no credit history or you only have like one credit card, that's what we refer to as a thin file in the business. So you have a thin file, you have very little information for us to determine whether or not we think that you are a reasonable borrower based on this system. Okay, so with this, you will want to build your credit over time by being smart about when to take out loans and when not to. If you can pay for a car with cash, it may still be smarter for you to get a car loan, make a handful of payments or a year's worth of payments, pay a little bit of interest on it, and then pay it off, just to help build your credit and to show that you are a reasonable or responsible borrower. Okay, I know I covered a ton of information right there. Why don't we take a little bit of a break and we review some questions. Okay. So some of the questions that I got, in advising my adult child to get her credit straightened out, I recommend paying off debts with fees and high interest rates first. Now she is down to 2 outstanding balances. Is it better to throw all of her money towards eliminating one or divide against the remaining 2? That's a really great question. So this has to do with like paying down your debt and a debt elimination strategy. The most efficient way to eliminate debt typically is to focus on whatever has the highest balance interest rate first. That's the most efficient way to do it. So make minimum payments on everything except for the most expensive thing out there and significantly pay off that as possible. I hope that helped. Question here. You may address this later. Late 30s, never applied for a home loan before, but would like to be a first-time home buyer. I've been working to improve my credit. As recently as today, I found my score as low as 650s, as high as 712. What model should I pay attention to? What should I focus on most? This is a really great question, and it's kind of specific. You want to focus on the FICO score primarily, because I do know that most mortgage loan officers, mortgage originators, and underwriters still use the FICO model. So we're going to talk about the VantageScore here in a second, which is the one that Credit Karma uses and a lot of other free websites use. Today, most credit card companies and banks issue you a score for free. You know it's FICO if it says FICO. FICO is a trademarked credit score, so that's the one you want to try to focus on. In order to like build your credit, like there's a lot, like that's a more in-depth conversation, and there's a lot of kind of intricacies to that. So if you want to email me, I could maybe help you out with that. Student loans, that's another thing. Student loans are an interesting situation. Yeah, we're not really going to get too deep in the weeds on student loans. I got a whole 2 hours I can talk about student loans. Next question from Jay Lee. My daughter is 6.5 years old. Should I be monitoring her credit? Yes, actually you should. We were going to talk about that, like how and when to pull credit and the purposes of doing that. Credit monitoring is something, I don't pay for credit monitoring. I do it myself. It's really very easy to do actually, and it's something that you should definitely consider because that's one of the best ways that you can identify potential identity theft. So I got a website that you can go visit when we get up here. And now what a lot of people are doing and encouraging folks to do, and this is free now, especially since after the Equifax thing, is credit freezes. Like you can have your credit frozen, which basically, I don't know why it's not already a feature. I mean, I do kind of know why, because the credit bureaus and credit card companies are in business to make money, and this costs them to do this. But credit freezing is basically like, I liken it to a two-factor authentication process. So like if you actively tell the credit bureau to freeze your credit, then no one can access your credit until you go in and unfreeze it. I don't know why that's not already how it works, but you have to do it, and it's free to do, and it's free to unfreeze now. They used to charge fees for it. First-time home buyer. You think getting a car tomorrow or should wait? So this question coming in here is about buying a car and financing the rest, purchase a home in 2021. Yeah, if you don't currently have a car loan, then financing the car, if your credit score is super good, I don't think it'll make much of a difference. Like your initial, I'm sorry, I didn't read that question out loud. So this is talking about like purchasing a car. This person wants to purchase a car. This person wants to put down some sizable down payment and finance the rest. And the plan is to purchase a home in 2021. So you have enough time now to do the application. Your score, you'll notice that after your score is really good. The score person has quoted a score at 787. So you'll get a good rate. Your score will go down just very briefly right up front because you'll have an active hit on your credit. But as long as you're making the payments on that loan in about 6 months or so, then your score will be not only where it was, but potentially higher as long as you're making your payments on time and you're keeping your credit card balances low. Like really those two things, payments on time and keeping your outstanding balances low. That's really good. How do deferred student loans affect your score? They don't. They're on there, but they have no calculation towards your score whatsoever because you're not required to make a payment. Only when you're required to make payments does payment history have an impact on your score. And positively making payments will help your score. Missing payments will hurt your score. In deferment or forbearance, you are not required to make payments. Therefore, you don't have to do that. It doesn't hurt your score at all. Now, what I do recommend doing is while you're in school, if you can afford to make some payments, do that. It doesn't help your score at all, but it helps reduce your overall interest that you pay on your loans. Refinance a loan. This is talking about loan rates. You want to try to get, like, especially on long-term big debt, like a mortgage, really rates matter in the long term. The difference, anytime you're looking at like a rate difference of around 1%, that typically is when you want to take action, like almost definitely. If it's less than 1%, you'd have to just run the numbers and see, you got to figure out what your objective is. If you're trying to free up extra cash in your budget right now, you want to reduce your payment, might be a good time to refinance. If you want to reduce the overall cost or pay your mortgage off faster, may also be a good option. But what you have to weigh in that decision is closing costs. That's usually where the rubber meets the road, like where the difference comes in. Okay. All right. I noticed there's some chat going on. We're going to come back to the chat kind of towards the end. I got a couple more slides I want to roll through. I hope this has been helpful so far. I know it's really dense. I hope I'm not going too fast. And yes, this is being recorded. I noticed that was a question. So a lot. I know this is a lot. Why does it matter? Why do you need to have a good score? It's more than just whether or not you're gaining proof for a loan. It's also how much you're paying in interest. This is something that's called risk-based pricing. That's relatively new concept. It came around in like the 80s and early 90s. Our friends at Capital One were very instrumental in developing risk-based modeling for credit cards. That pretty much they were a spinoff of a local bank here in Richmond called Signet, and they just took off like wildfire because they were able to issue credit to people who would have traditionally been denied or declined. They charge them higher interest rates, though. That's how you're able to offset risk from the lender's perspective. So as you can see on the screen here, the rate that you pay on a lot of loans, not all loans, but a lot of loans, is directly correlated to your credit tier. All right, so on the screen, that's example only. Those are not our tiers, and those are not our rates at the credit union. But this is like an example of, I think it was like a $25,000 car loan. And I think this example is from like before the financial crisis. The rates are like a lot lower than they are now, or a lot lower now than they were then. The lower your score, the more you have to pay in interest because you're a higher risk for the lender. So this is very important. Other places also do use your score now, like employers and utility companies, insurance companies. All of those places want landlords is another one that definitely looks at your, because they want to know if you have been responsible in the past about paying your bills. Like that's kind of the whole point of this. Now, the employer thing, I'm not a fan of the employer thing because there has been zero correlation of someone's credit history and their capacity or ability to work. I guess the credit bureaus have convinced HR representatives and people that like all else equal, credit is a determining factor in whether or not somebody is a good hire or not. There is no statistical correlation between somebody's work performance and reliability on the job versus not, but some places do still do it. Now, if you go to work at a bank or a credit union, they're going to ask you to have good credit because if you can't manage your own money, it's good to, not can't, but if you have had troubles managing your own money, it's probably not in their client's best interest to be advising people on their financial situation. Okay, so how to improve your score. These are kind of this is kind of the high notes. Always pay on time. Pay on time all the time is the number one thing you can do. If you find yourself in a situation where you can't pay, then contact your lenders. Do not run away. Do not think that it's just going to resolve itself. That's the worst thing you can do is just ignore it. Try to pay down your existing debts. That's what we talked about with that utilization ratio. Diversify your credit. Sometimes you do need to get a loan just to help beef up your score, car loan, personal loan, things like that. Even if it's something that you can afford to buy with cash, sometimes you may want to do that just to build up your credit. I know it sounds silly and stupid, but that could be the difference between a 3% mortgage and a 2.5% mortgage, which in the long run is tens of thousands of dollars. Okay. Keep your old accounts open as long as possible. Check your report for errors, which I'm going to show you how to do that in a second. This says limit balance transfer. So balance transferring is a technique that a lot of people like to use where they jump credit card balances from one place to another. I don't say don't do it, just don't do it all the time, especially if you're opening up new credit lines for the purpose of doing that. We have a great program at the credit union. Every other quarter, I think we run it, where we allow our members who have credit cards with us to transfer their balances over to us with no fees. There is a rate for 2 years, but there's no fees in doing it. That's a lot of times where people get hung up is with or get charged or with fees and things like that. Avoid excess credit applications. And if you're in the situation where you're trying to build or rebuild credit, you must be patient. You have to understand that this is about like building a reputation over time and learning how the game works. Like this is a score, if you want to get the high score, you've got to learn how the rules of the game work. And then you got to play the game, but there is nothing that will happen overnight that can instantly fix your score. Which brings me to a slight warning. Now, there are companies out here that help people build or rebuild credit. There are other companies, and a lot of them are really good. They do great work. They're called credit counseling services. Oftentimes they're like run through nonprofits or through financial institutions that you already work with. There are also kind of predatory companies called credit repair companies that for a high fee claim to fix your credit overnight. Be very wary of these. Basically what they do is bombard the credit bureaus with dispute letters for information that is both true and untrue. Anything that you dispute on your credit report that's not true, the credit bureau will take a look at, and if they find that you're right and it's false, then they'll take it off your report. If it's something that is true, anything that's in a disputed status on your credit report does not actually calculate towards your score for 30 days until that is reviewed. And so what credit reporting or credit repair companies do is they just bombard every month. They'll send letters to creditors, even if you were delinquent on these things, disputing that. And so it just basically looks like everything in your report is being disputed all the time. You can do that yourself if you want, especially if you feel like that disputed item is not legitimate. But the minute that you stop paying those fees, they stop sending those letters and that information goes right back on your credit report. So sometimes they also refer to illegal things like getting a tax identification number and using it like a social security number, which that's illegal. So just be aware of that, be wary of that. Other types of scores used, like I mentioned, VantageScore. This came around in like the mid 2000s as kind of a competitor for FICO. Apparently it's picking up some steam, but it's still not as widely used. It's given away for free a lot. So if you ever get a free score, sometimes it's this one. They used to have a different scale, but they recently matched it up to FICO to make it a little bit more familiar to people. It just calculates things a little bit differently. Other types of scores that are out there that are really not known at all, but we do use them, are a bankruptcy risk score, which so your credit score is the main score that we use to determine how likely you are to default on a loan. Well, there's another score that determines how likely you are towards bankruptcy within the next 12 or 24 months. That's a little bit different calculation. That primarily looks at like unsecured debt and missed payments, like almost exclusively. Non-traditional things do look at stuff that's not usually on credit reports, like bills and other things that are like utilities. You can request those if your credit score is bad, but you're good at paying your non-credit bills, like your Dominion Power bill or your Verizon bill, things like that. There was a push a few years ago to try to get that information included in the credit report system, but it turns out after they ran the analytics on that, more people would probably be hurt than helped with that, because if you're struggling to pay your credit cards and your loan payments, you're probably struggling to pay your other bills. So that they determined that it would actually hurt more people than it would help. And then mainly we use, like everybody uses internal, these are typically components, like the credit score is just a component of an overall credit review or underwriting process that we go through, which includes other ratios like your debt to income ratio, how long you've been a member with us, like other like account history, things like that. So it's more than just your credit score, although a lot more, like I mentioned earlier, a lot more of it is being automated to rely more heavily on those scores. So it's really important for you to just pay attention to this and try to make sure your score is in like healthy shape. Like you don't have to have an 850 to get approved for like the best credit ratings or offers that are out there. And honestly, like the way that the system is set up, like a lot of places actually, like the lenders themselves, prefer people that don't have impeccable credit in some aspects because they're able to charge a higher interest rate. And there are consequences for not repaying your loans. And this is one of them, especially for like unsecured debt. So it's it is what it is. This is how the system works. So in order for you to get your score, again, the score is typically proprietary, but a lot of banks and credit unions and credit card companies start doing this now. We started offering this through the mobile app. If you have an account at the Virginia Credit Union, you have our app. We will give you your FICO score once a quarter based on your Equifax report. Okay. I also have a Discover card in my wallet, and they use a FICO score once a month from my Experian report, which is awesome. So I get to see, a couple different ones. Another benefit to having multiple different credit cards. Now, the credit score is a reflection of the information that's in your report. In order to monitor the information that's in your report, by law, you're eligible to review your report one time every 12 months for free at annualcreditreport.com. I just squeezed that in on the bottom of the screen here. Annualcreditreport.com, and you can put in your information, and it will allow you to pull each credit bureau one time every year. So you can pull all three at once, but what's typically recommended, and this is what I do, I have it on my calendar, is one credit bureau every 4 months, and you can kind of take a look all year round. Okay, I don't need to know specifics all the time about what's going on my credit, mainly because the credit union tells me how my credit is and tells me how my score is. If you have a credit union or a bank or a credit card company that doesn't give you your score, another way to kind of put a good gauge on how your credit is doing is by credit offers in the mail. If you're getting good credit offers in the mail, that means they're pulling your credit and they think you got good credit. Or they think you're going to take the credit. Like that's the other thing. Just because they're offering it doesn't mean you should take it. I ignore most offers that come in the mail. I strategically selected a few cards that have certain benefits that I like in terms of my credit card portfolio, if you will. I hate paying fees on stuff. The only credit card I pay a fee on is associated with my Costco membership, which you'll have to pry from my cold dead hands because I am a Costco just fanatic. So Costco, love that one. Okay, so last thing I'm going to hit on before we hit up some more questions here. Again, I know this is really dense and I appreciate you guys hanging with me. Is when to ignore your score. So your credit score is something that you really only need in certain moments, like when you go to apply for loans, like big loans, or when you go to apply for a mortgage or a apartment, things like that. It's something that's always kind of there and always keeping track of you. So you should never really completely ignore it. But if your score is already really good, keep doing what you're doing. If you know you're not going to be using it, I got this question one time, which I thought was really interesting. I was doing a in-person presentation at the hospital, the Learning Center at MCV, and somebody came up to me and they're like, "I'm getting ready to retire. I have enough money to buy a car with cash. Should I do it?" And I said the person only wanted to make sure that they kept their credit in good shape when they went into retirement. And so, at the time, rates of the credit union were like 2%, like 1.99 or 1.74%. And, if you do the math on that on like a, $20,000 or $30,000 car loan, it's really only a few $100s in interest. Or I think the person's credit was so good, they probably could have qualified for interest free. You know, it's not a bad thing, but if you know you're going into retirement and you're not going to be borrowing money for any reason going forward, don't worry about it. You don't need to be concerned about your credit score. Close your old credit cards. Who cares? It doesn't matter. The last thing is if you have more important financial issues to handle, like if you've gotten yourself over your head and you are really can't make your payments and your income has stopped completely and you have no short or midterm ability to restart your cash flow engine, your income, don't worry about your credit, worry about your health and your life and your shelter and your food. You can rebuild credit later. You can rebuild credit later. Everything has a time limit on your credit. Most things will drop off after 7 years. If you choose to file bankruptcy, it will be on your report for 10 years. The only thing that is on your credit report in perpetuity forever is unpaid taxes. Good old Uncle Sam reserves the right to keep that on forever, like forever. So with that, I'm going to put my information back up on the screen here. And Letitia, if you want to come back on, if you've noticed any questions that have popped up, or if you have any questions, I'll be happy to address that for the last few minutes that we got.
Yes. Again, for those who hadn't already submitted questions, we do have some time now for these last 10 minutes to have any questions answered. Tom, you were doing great until you mentioned Costco. I am your rival. I love Sam's Club. I am a Sam's Club.
No, that's all right.
But
yeah, you can get tires and like 700 pounds of cheese at one time. I'm all in.
Yes. So, and then did we get to this question here? I took out an unsecured loan. We already got to that one, right, Tom?
Which one was that?
Took out an unsecured closed-end loan from my credit union to pay off some higher interest credit. Oh, we did. Okay, perfect.
Yeah, that's a good one. So the question was they got a unsecured loan to consolidate debt, which that's a really great strategy. In order to keep your score high, though, don't close the credit cards. Like you want to, like if the credit cards are tempting and you know you're going to rack the debt back up, then close them, take the hit on your credit. But if you do a debt consolidation loan, leave those credit cards alone. Just let them sit there. They're actually helping you, not hurting you. If you pay the loan down quickly, that's just good financial sense because like the way that loans are amortized and the way that time value of money works, when it comes to paying down loans, the amount of interest you pay is a function of the principal. And so if you can pay the principal down faster, like make extra payments, then mathematically always you will pay less in interest, which is a good thing.
Great. So again, if you all have these burning questions while Tom is still here, please feel free to submit those to us. And I also included Tom's email in the chat function. So I know that some people are like, hey, would love to chat with Tom about some personal issues after. So I put your Virginia Credit Union email. That's
perfect. Yeah, that's great.
Okay. I had a question, actually. You talked about you personally just refinanced your mortgage. And so I am actually looking to do the same thing. Something that threw me off, I actually got a letter in the mail And I'm always just funny about that. Like I hadn't heard of the company that was offering, but it was like too good to be true type of offer. So who do you recommend you refinance your mortgage with so that you're not gypped or you don't feel bamboozled?
Okay, I'm biased. I'm biased. I'm
yeah, that's
biased.
true.
And I did just refinance with the credit union, but I'm a good consumer, and I did put in loan applications with 3 lenders. Here's the
Okay.
rule of thumb. This is the rule of thumb, right? So whenever you're shopping for credit, okay, always review. And if you're shopping for like whenever you're doing like anything with a home, whether you're shopping realtors or loan officers or lending companies, 3 is a good rule of thumb. If you can get 3 and talk to 3 different people and get 3 different quotes, that's fine. Now, I know some of you are going to say, well, if I put in 3 loan applications, then that's going to ding my credit score 3 times. Not the case. So that's one thing. And I'm glad that you brought that up, Letitia. That's a great question, because whenever you're shopping for a specific type of loan that falls into a bucket, like a mortgage, you are allowed, have a 45-day window in order for you to shop rates before they will, if you go outside of that 45-day window and then you like apply for 2 or 3 more, then it'll show up again. So anything that happens within that 45-day window of your first loan application, whether that's a pre-qualification or the actual application, you have 45 days. And then as soon as that 45, and then everything within that 45-day range only counts towards your score 1 time. So the same happens with car loans too. Like when you go into a car dealership and you sit with their finance guy, they actually look at 15 different lenders and they compete for whatever the best rate is. Because the finance guy doesn't care. The finance guy's trying to get you the best rate, so you walk out of there with a car. So they shop like 15 different rates, like Wells Fargo dealer finances, 10 different credit unions, online banks, all that kind of stuff. It is your responsibility to be a good consumer and shop around. Start with the places where you do business first. I don't reply to mail solicitations like ever because I just don't. And I'm sitting in my office right now, and our mail people, like our marketing folks, might be hearing me right now. I don't typically respond to mailings, but I do look at them. Like I will look at them, and especially if it's like from a place where you're already a customer or a member, like that's a good place to kind of start. Other good companies though, like I know I've heard good things about like Quicken Loans and Capcenter and all these.
Yeah, I was looking into Capcenter. So I want to make sure everybody else gets their questions in too. So somebody did ask, but doesn't Virginia Credit Union only finance property in Virginia?
Yes.
Okay, so yes, they
good
only
question.
finance property in Virginia, because I know we have some alumni all over the country. So
if you're coming from outside of Virginia, I'm a convert. I used to work at a bank. I am a credit union person head to toe. So look for a credit union near you that you are eligible for, and at least give them a chance to have a good rate. Sometimes, like when applying for mortgages, you want to make sure that you're comparing apples to apples, because of the way that like fees and upfront costs are kind of communicated in certain types of loans and what's financed in and stuff like that. I don't want to necessarily say it's deceptive. It's just different. So you want to make sure you're comparing apples to apples. I got another one in here down in the chat about doing the twice a month rather than once a month loan payments. That's an awesome way to help pay your credit down faster, to pay your loan down faster. And it doesn't hurt your credit. It has no impact on your credit. As long as your payment is received in full by the time your loan payment is due, then you're in good shape. So basically, like there are lenders which will allow you to, instead of making 1 payment a month, they'll allow you to split it up and do either 2 payments a month, or, which we have this option through our loan servicer at the credit union, is to do every other week. So instead of making 24 payments in a year once a month, you're making 26 payments or the equivalent of 26 payments, because you're paying every other week as opposed to every month, which is great because that allows you to pay your principal down faster. And if you can make 1 additional payment towards your principal on your loan every year, your mortgage, you can actually knock about 10 years off your mortgage.
Wow.
Yeah.
Game changer. Okay, I know we only have about 3 minutes here. So we're going to try to get to as many questions as possible. But again, I did put Tom's email in in the chat. So which is better, Tom, conventional or FHA for
Mm.
the mortgage loan? I'm sure that's probably its own.
Yeah, that's, yeah.
Session.
Maybe we can come back and do like a home buying or home financing class. I got one that I
Yeah.
can go through the whole nuts and bolts of that.
Okay.
Everything depends on your situation. Like that, I get to use that common cop out for finance questions, which is it depends. It depends on how much down payment you're looking to put down. It depends on what closing costs and options are available. Yeah, it depends. My first loan was an VHDA loan through the Virginia Development Housing Authority, Virginia Housing Development Authority, which was great. It was an awesome loan. It was more expensive. My rate was higher than a conventional loan, but I didn't have to put a lot down. And as a first time home buyer, that's usually the hurdle is like, you know, I mean, if you look at 20%, like who's got 20% of a,
and still buy furniture.
$200,000 house?
Still buy, yeah, right.
Yeah, and still have the closing costs and still have extra money left over for emergency savings. And yeah, it's a lot. So it depends.
Yeah. Let's answer one more question here. Again, I'm sorry that we couldn't get to everyone's, but one last thing here. What is your advice when it comes to paying off loans during COVID? I know there has been more grace offered with student loans, but under what circumstances should you not pay them down?
Excellent question. And I think about this a lot. Like that's another, it depends. And I've actually taken advantage of taking a pause I have student loans and my wife has student loans. And we also have a 7-month-old baby at home. So my financial situation is changing rapidly and I'm needing to adapt quite a bit. But I have actually taken a pause on paying my student loans. Now is a good time to try to get ahead. So really, like whenever you're looking at like what your strategies are for repaying your loans, you have to think about what your desired outcome is. If you want to get out of debt as quickly as possible, doesn't matter what your situation is, pay as much as possible, as fast as possible. So that means continue making your loan payments if you can afford them, all of that. Now, if your loans are in a 0% forbearance situation like they are right now, if you're in a public loan forgiveness program, like you work for the university or for the state or something like that, it's not a great idea for you to be making those loan payments because you're trying to get your loans forgiven in the long term anyway. So the less you pay through the length of that process, the better. And they're counting them as payments being made on time. So like you're double maximizing that benefit. If you're struggling for cash right now, that's the cash flow scenario, then obviously not paying them when they're at 0 is the best thing for you to do. So, if again, it depends on what your objective is. I'm not doing it right now because it's 0% and I don't have to. So I'm like taking that money and putting it into something that's more valuable for me.
Yep, me too. I'm getting married in April, so I'm just using that money to save it up. Well,
stimulus. Now's a good time to like stockpile your cash. Cash on hand. Like build your emergency savings. Look at other goals that you have. Like it's a good time to do that.
Great. Well, thank you, Tom, so much for your knowledge and expertise that helped and guided our conversation today. And thank you, everyone, for attending today's webinar. I know we're 1 minute over, but that's okay because it was great information. So within 24 to 48 hours, you will receive a follow-up email with a link to a short survey to complete. So we would really greatly appreciate it if you could fill it out for us so that we know what types of events and what types of topics you all are looking for. I also put in the chat the link to our next event of the series is Are You Financially Healthy, which is also with the Virginia Credit Union representatives. So super excited to have them be a part of this series. Also, on behalf of VCU Office of Alumni Relations, we just want to say thank you all. Thank you to our amazing speaker, and thank you for joining us today. Have a great rest of your day, everyone.
Thanks. Go Rams.
Go Rams. Thank you.